So anyway, based on the shooting star confirming a resistance area, the bearish engulfing pattern, and a price target to the bottom end of the trading range, this looks like a fine risk-reward strategy. Nothing wrong with going short here, because this would be we'd be selling it here, our stop would be here, and the target would be all the way down here, which is fine. Okay, now let's move on to the next session. What would you do? Okay, this is the day after the shooting star. And actually, okay, first of all, what pattern is this? Okay, we saw the shooting star, but now we're looking at the 3 candlestick signal. So what pattern is this? There's actually 2 questions here. And the second one is, what would you do? So put it on pause. Okay, so moving on to the answer. Obviously, hopefully it's obvious, it's an evening star, 3 candlestick signal. An evening star comes after an uptrend, even a short-term one. Long white real body, the bulls are in charge. Small real body, and a black real body that gets deeply into the white candle. Classic evening star. One of the questions I'm asked a lot at my seminars is, which are the more negative candlestick signals? Which are the more powerful? And my standard answer, and the one I'm relaying to you, is you have to show me the chart. And the reason for that is because it's extremely dangerous to view candlesticks in isolation. We have to look at the candlesticks through the prism of overall market conditions. And this is a great example. Let me show you why. We would think normally an evening star has more potential to be a good short sale, right? Because we have the black real body pushing deeply into the white real body. So we would think it's potentially more of a good short sale than the shooting star, correct? But let's look at this. Before, we saw the shooting star was a good trade because of the risk-reward. Think about the risk-reward if you went short on this evening star. Would that be a good risk-reward trade? And the answer is no. Okay, remember, we still have the high of the bearish engulfing pattern here, and also now the high of the shooting star as resistance. So if we sell it here, our risk is, as shown in the red arrow, that's our risk. And remember, this market was in a trading range. So our target potentially is the bottom end of the trading range. So it looks like the risk reward is almost 1-to-1. That is not a trade to take. And this is a perfect example to show how, although the evening star can be a bearish signal, there are times when we would not take the signal as a time to initiate a new position because of the poor risk reward. So with the evening star, we would have not done the trade, but with the shooting star, we would have because of the very good risk reward on the shooting star. So the answer here is do nothing due to the poor risk reward. Now, what would you do here? So I've shown you the highs that the market made, the euro made in August, these red dotted lines. What would you do? And I'll give you a little hint. Also look at the highs in May before you make your decision about what you're doing here. So pause now. Okay, so let's go through this. So we could see that the market is above first resistance, what I'm calling R1. First of all, this is so small, it's a doji, and very long lower and upper shadow, so it's a high wave candle. So it tells us the prior trend, in other words, up, is losing steam. The trend is turning more neutral. What do we do here? You know, the market's above resistance, but we have a signal that the market's losing momentum. But is it really above resistance? It may be above this resistance, but remember I gave you that hint before about looking at those highs in May? It's not above this resistance area here. So this is one of those scenarios, by the way, that blue line is second resistance. So the market's above the first resistance area, but did it break this first resistance with a tall white real body here? No, it was a spinning top. Now, by the way, the market may have broken the resistance here, but it did it marginally. The next day is when we have this spinning top, this small real body, and then some confusion. So although the market's above the first resistance area, it certainly didn't do it with vibrancy. It didn't show us the bulls had full control of the market. And even if it did have a relatively tall white candle here, the market is not above the resistance area here at R2. So what would you do? In this scenario, nothing. If you're long, maybe take some profits, but I certainly would not sell short because, first of all, the market's at resistance, R2, with the spinning top. That might be a reason to sell short, but unfortunately, it's above this prior resistance area. So this is one of those times where there's no clear-cut direction. Nothing wrong with standing aside. Now, interestingly, let's look at what happened after, what unfolded after. So as I show here, the market's above R1, but also near R2, so do nothing. So let's look at what happened after. This was the candle line where we said, what would we do? And interestingly, the market broke above. It ultimately did break out above the August highs, and also it did break above the May highs. We don't show them over here. And one of the great things we could do with the candles is, or on a candlestick chart, I should say, is use all classic Western charting techniques. This is why it's so important to use Western charting techniques, because with those, we can get measured targets. And one of my favorite targets is taking the height of the trading range, and you can see the market was in the trading range. The low is here, okay, right around 124, and the top end of the range was right around 129, maybe 129.5 in that area. So essentially taking the height of the trading range, and whichever way the market broke out, in this case it broke out to the upside, just take the height of the range. And normally, when we do get a price target, such as we had here, doesn't mean the market's going to stop, but interestingly, right at this price target, boom, what did we get here? The black candle wrapping around the white candle? That's right, a bearish engulfing pattern. So if we went long, let's say on confirmation on this white candle, sometime during this white candle, remember during this white candle, this is a daily chart, you may see something intraday here that would let you get in early on this trade rather than waiting for the close of the white candle. But let's say you went long here, on this decisive break above this resistance area, and your target was over here based on the trading range, adding it to the breakout point, and then you get the bearish engulfing pattern, time to exit. Remember, as I said before, one of the powerful aspects you could do with candlesticks is use it to exit, especially when it's confirming a measured move. So I want to thank you for joining me, and I hope you found this informative, and may the candlesticks continue lighting your path to greater profits.